ADM looks to be at a bargain price right now at its 52-week low and with an 11% dividend increase just last week. But is it a strong buy now given the crash and the reasons why? We're going to take an updated look today. We're going to run through their revenue top line and bottom line net income given that issue that they did have to see whether or not we can rely on the data. We're going to look at their balance sheet, a quick health check. They did report, so we want to find out, is this a company that does have a good balance sheet? And we will see how they have performed over the last 5 years. As always, we'll re-look at that dividend safety, talk about their financial metrics, whether or not any of this data could be affected by those reasons. We'll very briefly touch upon some insider selling by the vice president. We'll look at the institutional ownership Q4. What are the institutions doing? We'll also do a quick recap as to why it did plunge last week. And we'll very briefly take a look at analysts, whether they are saying it should be a buy, hold, or sell. And interestingly, we're going to very briefly discuss this film that was brought out in 2009. And finally, we will run it through our valuation model. We'll get to our intrinsic value, get to our acceptable buy price given that investor margin of safety, as well as seeing what are Wall Street forecasting now that that issue has arisen. Do they still see this as a very strong buy? So let's jump straight in then to the analysis. Well, over the last year, they are down 39%. We can see this drop after that issue from $68 to the current trading price. Over the last 10 years, however, they are up 32%. Bear in mind, it doesn't include those dividends reinvested. And we can see their all-time highs in 2022 of just under $100 and again at the back end of 2022. In terms of PE, well, forward rate 7.4 and the yield is just under 4%. So very quickly, let's take a look at their income statement. Now, what we typically look for, 3 to 7%, remember, year-on-year growth. $64 billion in December 2018, $102 billion in their latest annual report, although that was from 2022. So there is some strong growth over the last 5 years, but there's two things I want to point out here. The first thing is from 2018 to 2020, it was essentially flat. It did then increase from 2020 to 2022. But again, I want to point out that the 2023 trailing 12 months is showing signs of a drop. So we can look at it. It is a positive. They have grown their top line over the last 5 years, but just bear in mind there are some inconsistencies, and we will touch upon the percentage increase year on year shortly. Bottom line, $1.8 billion in 2018, $4.3 billion in 2022. So yes, their bottom line has also increased, but again, more inconsistencies. We see it in actual fact drop to 2019 before increasing all the way to 2022. But again, a drop is expected to the bottom line as well as the top line when they release that full annual report of 2023. So inconsistencies are there across the income statement, but bear in mind over the last 5 years, they have still been increasing both that top line and that bottom line. Now, in terms of the balance sheet, they held $2 billion of cash and short-term investments in 2018. From their latest report, this has dropped slightly to $1.5 billion. And when we compare that numerically and directionally to their essential total debt, we see that has increased slightly from $8.4 billion to $9.5. So their cash is dropping, their debt is increasing. Something just to bear in mind when we look at the dividend safety as well as the net debt to EBITDA metric. So let's very briefly have a look for those that didn't see the news last week, why the stock did plunge significantly. And essentially their CFO was placed on leave as part of an internal investigation into accounting practices. Now, this is quite a big red flag indicator, and as we can see, investors were concerned. Shares did on that day go down nearly 20%. Now, the issue here is that if it has been in one area of accounting, who's to say this hasn't spread across all the accounts if they have essentially fiddled with the numbers? So that is one risk that I want you to bear in mind as we go across our analysis in today's episode of ADM. Just because we look at the numbers, yes, revenue is increasing, yes, bottom line is increasing, but just bear in mind there is a risk that when this internal review is performed, that it could have spread to other figures and not just one level of the business. Now we can see it is on the radar for the wrong reasons. Now this is because Ismail, the interim CFO, was placed on leave. But again, just bear that in mind. The reason they are talking about this is it's just purely the company's nutrition business from what they have found so far. It doesn't relate to every single part of ADM's business. Now, in terms of what Yahoo Finance is saying, is this a buy? Well, markets completely and obviously do not like this uncertainty with the investigation, hence why we saw that 20% drop on the day. But you can look at it as two ways. One, is this a potential to buy a very strong undervalued company, or is this stock heading further down and is that justified? So something just to keep in mind. And as we can see here, agriculture overall does tend to be a tough business. And as we can see, they have underperformed the S&P over the last 5 years, bearing in mind that drop. So let's now take a look at that performance of ADM over the last 5 years. We're just comparing them to companies in the same agricultural and products and services industry. Now, obviously, this will have massively affected their performance after the drop. We can see this includes those dividends reinvested. Now, ADM is the worst performing over the last year. When we extend that to the last 5 years, ADM surprisingly is in the middle of its peers. Something just to bear in mind, as we always say, past performance is never an indicator of future performance, but it is very important to use as part of your investment analysis. Now, very quickly, what we're looking at here is insider trading, insiders buying or insiders selling. Personally, insider buying for me is a very bullish signal. Management typically buy shares if they believe the share price of their company is going to shoot up. Insider selling that we see here, now this is just really typical. If companies or insiders are selling, it could be for a wide range of reasons, whether that is personal reasons or financial reasons. Now, just to let you know, I have put the screener for the last year, hence why we are seeing this from the middle of July. So you could argue it is a bit outdated, but otherwise there is nothing else to note, no insider buys or selling in the recent period. But it's interesting, the Vice President Strader here, as we see, did sell 1,500 shares at $87. Now, since then, the share price has dropped 40%. Just some food for thought. Now, in terms of institutional ownership, 78%, 3.44 billion worth of sales by these institutions over the last 12 months, nearly double that of buys over the same period. Again, this was all, in fact, before this accounting issue, so do take that in mind when you are looking at this data. But we can see in Q1 to Q3 of 2023, there were more buying by institutions. Q4 now, we do see more selling by these institutions than buying. Again, something just to consider as part of your investment analysis. Now, one thing that I did want to bring your attention to is this film. Now, typically, you might be thinking, why are we looking at a film on an investing channel? Well, this film, funnily enough, is a true story and it is based on ADM. As we can see, the US government decided to go after an agro-business giant with price-fixing accusations. Now, when we will scroll down, and I don't want to spoil this film for people who are interested in watching it, but what we can see here is the storyline is based on essentially Mark, who has worked for ADM for many years and even found his way into upper management, and now he is looking to be an informant against illegal price-fixing activities of ADM. So it isn't the first time they have been under the spotlight. If it is something you are interested in, then go ahead, take a look at the film, but just something I wanted to flag about ADM, whether or not this is their first rodeo. Now, before we look at those financial metrics, we can take a look at what the analysts are doing. And we can see a lot of analysts have changed their minds on their ratings based on this news, moving from outperform rating to neutral and reducing their price targets from $96 to $61, which we will take a look when we perform our stock valuation. And we can see some have lowered it even down to $60 and then some up to $76. So essentially, the main conclusion of this, that there are a lot of revaluations for analysts on ADMs, but overall they are bringing it down from the high 90s, the high 80s that we have previously seen, to the high 70s and the high 60s. So again, just something to consider. So let's get into the main part now. Dividend safety score 80, it is safe. Market cap 27.8 billion, it is a large cap company. In terms of key recessionary metrics, well, they increased the dividend in the last recession. Below average growth, remember S&P growth was negative 12%. They also outperformed the S&P 500 negative 21% versus the S&P's negative 55%. In terms of dividend growth, well, a surprising 11% dividend increase, double digits this month, the same month that this CFO was placed on leave for accounting errors. So whether or not that fills you with confidence, you could argue it is a positive sign. You could argue they are trying to hide something by doing this increase to take people's minds off the potential issues that may arise. Over the last 5 years, 5%. Over the last 20 years, 11% on average. And they're nearly a dividend king. They have been increasing those dividends for 47 years or more, and uninterrupted dividends for the last 92 years. In terms of dividend yield theory, for those viewers that are new to the channel, it states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. Another sign here, the forward PE below the 5-year average. So a double sign. Please bear in mind we don't look at any of these models in isolation, and we will draw conclusions towards the end. Sector PE, well, it's at 9 for ADM versus consumer staples sector at 19.2. So it is significantly lower than that. As always, I personally ignore earnings data. It is available on screen if you want to take a look. Personally, free cash flow below 60%. The reason for this is it's below 60. It gives me faith that they are able to offer those double-digit increases. Now, this is why we tend to ignore the earnings. It is susceptible to manipulation by management through accounting. And what this is showing is that in 2023, they're expected to be 23% on the earnings payout, which you may look at as an investor, very, very nice, excellent. But when you look at the free cash flow, 196% expected on the free cash flow metric. Let me put that in other words. They are saying that management expect to pay 196% of the free cash flow, so more free cash flow than what they're paying out in dividends. So that is a big red flag indicator. Essentially, more dividends being paid out than what they're generating in free cash flow is a huge red flag indicator. Free cash flow per share, well, 652 in 2013. 384 in 2022, expected to go even lower. Not the greatest look. You do want to be seeing at a bare minimum consistent small increases, and we do note a very significant, in fact, the last 5 years or 5 out of the last 10 years, negative free cash flow. Sales growth, again, although some could argue the cyclicality of the industry, we see 5 years of negative growth, followed by a year of 6%. Remember, we discussed earlier in the income statement review, flat growth, and then 2 double-year digits of growth, which is positive. Again, we mentioned 2023, we are expecting a drop. Total sales then numerically, again, you might want to consider cyclicality of the industry. 90 billion in 2013, 102 in 2022, expected 97 in 2023. Now, in terms of some good news, they do share buybacks, they're returning excess cash to investor pockets. We can see the reduction here from 663 million in 2013 to 548 in 2023. ROIC, personally, I want to see 10% or more before investing in a company, as that gives me faith that management are able to effectively allocate their capital. We can see they have really struggled with this, although you could lower this for certain industries. 12% in 2022 is positive, 11% in 2023 again is positive, but I do like to see some consistency above that 10%. Operating margin, this is where the red flag indicator inside me goes off. We want to see around 16% or more. We're really seeing some very small levels here, 4% in 2022 and 2023. Okay, it's better, but it has struggled for some time. Although you could argue it is starting to increase, that is a positive. But this is a worry for me, especially if the accounting numbers have been meddled with. Are these numbers even accurate? You have to ask yourself that question. Free cash flow margin, they are really struggling, and we can see that clearly here. In terms of the net debt to EBITDA, or earnings before interest, tax, depreciation, amortization, new viewers, what that essentially shows us is the dividend safety as well as balance sheet strength. These numbers on the screen show us the number of years it would take the company to pay off all of their debt net of cash on hand. So it is very positive to note it has started coming down from 2019, and 1.18 expected in 2023 makes us believe that dividend is safe and their balance sheet does look very strong. So let's jump into the valuation of ADM, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Just before we get into the valuation, just to let you know, we have a free weekly newsletter. Last week's episode was on undervalued companies with a strong upside. The first week we did our 7 golden dividend metrics, where we ran through our screener for undervalued stocks. If you want to read that completely free, click on the pinned comment below to sign up to that weekly newsletter. So let's get into the valuation, and as we can see, we'll start off with Graham's valuation model. We have the earnings per share, 719, the growth rate per analyst estimates, and that AAA corporate bond yield gives an intrinsic value of $47.52. Now, based on the current market value, we have a sign of overvaluation, but bear in mind we're not looking at any of these models in isolation. We then move on to the multiple valuation model companies in a similar sector and size. We use the PE multiples to have the average multiplied by the earnings per share of ADM, and we get our intrinsic value, again signs of undervaluation, different to the first one where we saw overvaluation signal. We then move on to the dividend discount model, where in the more recent period they have been doing some very nice dividends increases, average 7.5%. We have gone a lot more conservative at 6%, getting an intrinsic value of $106, a second signal of undervaluation. We then get to the free cash flow, the discounted cash flow model with the free cash flows year on year. Growth rate per analyst estimates, well, it's much higher than 6%, but we have been more conservative, taking into account of these accounting record errors. Discount rate at 8%, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We have the intrinsic value, again, higher than that market value. So the intrinsic value for today's episode for ADM, as we can see, is coming to $76. Don't forget, you can grab a copy of the valuation model if you want to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio or on your watch list by clicking on the pinned comment below. Margin of safety then, we typically start off with 10%. And that's if it meets the three criteria: wide moat, strong financial metrics, good forward-looking data. At 15%, the acceptable buy is $65. At 20%, $61. 25%, again, still showing signs of undervaluation. And you can see here at 35%, it isn't quite there yet. So we see around at least 30% margin of safety based on the estimates and judgments. Now you have to bear in mind that if there are more accounting issues, the share price will fall further due to the fact that the markets are uncertain as what is true and what is false. However, it does seem that the price did hit its 52-week low and has started to climb up slightly. So it really does depend on your investor risk reward, whether or not you are happy to take some risk or you want to see the issues come out. But bear in mind, if the issues do come out further and everything does look to be okay other than that business, it is unlikely that the share price will fall. In terms of Wall Street and what they forecast, well, over the next 12 months, the revised target price based on the issues that were found is now at $70. And we can see they have upside of 34%. So Wall Street overall and by and large do still believe it is a buy, but again, it is something you just need to be cautious about and think about your risk reward ratio. As always, let me know your thoughts in the comments below. Is ADM one you are looking to buy? Maybe you're actually considering to wait for these issues to come to light and are happier to pay at a higher price, but to understand. And also let me know if you were surprised about that 11% dividend increase. As always, have a great day. Catch you on the next episode and take care for now.